Hello, everybody, and welcome to Confident Compounding with Corey Kramer. Today, we're going to be analyzing Westlake Corp stock, ticker WLK. This one came in by request in the comments of one of my other YouTube videos. If you have a request, put it down in the comments. I go through about twice a week, and I take those and I put them up on the chalkboard. I take the tickers and put them up there. I'll let you know when I do that in the comments, and eventually I'll make a video. I either post those here on YouTube or on my free tier on Patreon. That link's down in the description. I also have weekly picks on Patreon for $25 a month, where each week I go out and try to find the best stock that I can find in the market, and I buy those myself if I don't already own them. And I have a full service on Patreon as well now. If you want to see the spreadsheet that I'm going to use in this video that has about 700 tickers in it, and you can see what I think are currently buys and not currently buys in the market. Okay, as always, this is not individual investing advice, just how I analyze stocks. So Westlake Corp is pretty interesting. They are, according to Fast Graphs here, commodity chemicals company. I want to actually see, I didn't look up ahead of time which commodity. I think it's going to be petroleum based, based on just what I saw in the essential products. Polyethylene. Yeah, there we go. So epoxy. Okay, yeah. So just judging from the earnings history, I thought maybe they might be more connected to kind of to oil, but commodity chemicals is what we're looking at. So typically, commodity chemical companies are very cyclical. Usually, they correspond either with a larger business cycle or the industrial / goods business cycle, or a combination of both, if things coincide, which sometimes they do. So if you watch any of my other videos, you know I start off on Fast Graphs and I look at the historical earnings. I do have an affiliate link down in the description too for 25% off Fast Graphs if anybody wants to try it. They have free trials over there. It can be really good to make you more efficient at focusing on the stocks that look the most interesting. So when I look at this, I can see this green, dark green shaded area that represents earnings per share. I can see that pattern right away. And I can tell within like a couple seconds that it's a cyclical business, because these earnings go down here. You can see they go fully negative and then they recover, and then they go negative, like just growth wise negative here during this 2014 to 2016 period. And then they recover. And then even before COVID started, they were going down, and once that, the industrial kind of cyclical peaked in January 2018, so they coincide with that, and then they bottomed during the March 2020 COVID bottom, and then we had a commodity or a goods boom following that, and they recovered, and now they're falling again during the bust from that boom. And so, but the important thing is here, each one of these earnings peaks is higher than the last one. It's actually cleanly so, although it's unlikely that the next earnings peak will probably won't equal this super cycle here, but we'll see. That's what you want to see. You want a cyclical business that's high quality. The stock also corresponds to those earnings, so that's nice. This is actually almost a classic cyclical, deep cyclical business and stock. So really good one to examine, to learn about cyclical businesses and when not to invest in them. So because earnings fluctuate so much, earnings like a PE ratio and things like that, which I sometimes use on the channel, are not good ways to predict the future performance of the stock. So the PE ratio, let's just pick this peak here, was only 8. But if you bought around that time, you're currently down about 40%. It's a little trickier on some of these because usually the stock price anticipates the decline a little bit. But you can see, again, a PE of 8, but you would have not bottomed until down here, 45% lower. This initial drop is actually pretty good. This is what you often see. So you get this initial drop. It sucks investors in because that's an 11 PE, which is pretty cheap on its face. And this wasn't even like a huge drawdown. So then you have another 2 years basically while you're underwater before you finally can come out. And probably the Great Recession is the best one here. So again, we have a single digit PE right when earnings peaked. So the stock fell more than 50% from just that random period. Not totally random, but I didn't pick the tippy top. From that point when it looked cheap. But if you would have bought it when it was cheap, well, one, it didn't even have a PE because earnings were negative. But once it did, look at the PE. It's like 300. So that looks expensive, but it's not, because these earnings are going to recover very quickly because it's a cyclical business. So if you bought there, that would still be a much better spot to buy than back here. Maybe I'll shorten this because the scale is kind of, so you can see it a little bit better here. You can buy up here at this peak when the PE was pretty low, all through here. But coming out of it, well, one, there is no PE here, so then it looks really expensive because they're losing money. But during the initial phases of the recovery, that PE is super huge. But the stock's only trading at 12. Back here, the stock was trading at 18. Was trading even more. So, but it looked far cheaper. Well, that's the danger with kind of using earnings, especially short-term earnings, for cyclical businesses. So what do you do if we can't use the earnings? Well, I use the historical stock price patterns, as long as it's a high-quality business that has a history of recovering quickly, which this one does, but with earnings and stock price. So this is kind of, an ideal. It's not perfectly ideal, but it's a really good for a commodity chemical company. I guess the one thing I would look at is it does look like they have some debt. It looks like it's probably but a BBB plus credit rating. It looks like it's just enough to amplify maybe some of these drawdowns, actually, so it could be good, provided that the cycle doesn't stay down for too long. Historically, it hasn't, but that can change. So that's one thing to watch. I didn't go back and look and see what their historical debt levels were. I'd probably do that before I bought it, though. Okay. So we want to go back and see what these historical drawdowns looked like in the past. So I've done that already and logged them in my spreadsheet here. I didn't have this one in my spreadsheet, by the way, so I had to add it. But it was worth adding. And here are where I just kind of log those. So the 2008 drawdown, which is the one you saw at the beginning, roughly that same period. I think it started probably for them in like 2006 or something. But that period, it drew down 72% approximately. And then in the 2018 to 2020 period, it drew down 72% again. So that's pretty nice because you're getting consistent patterns that you can use to help guide a potential entry point. That 2015, I call this the industrial recession, 2014 through into 2016. It fell about 53%. So you have but that wasn't a full economic recession. That was more of an industry goods recession. Industrial recession is what I like to call it. So in that case, it only fell about 53%. So I consider that kind of a mid-cycle type drawdown, or an industry recession, whatever you want to call it. So we have two different potential historical types of drawdowns. The deeper ones, which tend to happen during recessions, which is more than 70%. The kind of ones that don't happen during a wider recession, those are more like 50%. So we have, those can kind of guide our thinking into where we want to go. Now for me, I would be aiming for that 70% drawdown. Here's why. So if we look at this boom that we had, it was such a kind of super cyclical boom that a lot of it is a part of a bust that occurred because of that boom. And we can see it with the earnings. So when you have kind of a big pull forward of earnings like that and a big up cycle, usually that means you have a deeper down cycle. So I would have expected that, given how now the stock price didn't fully embrace that. If you look at the peak prices, boom, 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 and boom, they are pretty much in line with what you would expect. They kind of ignored the earnings super cycle. But knowing kind of what's happening in the goods economy, which is definitely in a recession, even though the service economy is not, and then all the things going on with tariffs and everything, right now this stock is down about 55% off its highs when I checked on Y charts, so just slightly more, but it's down more than 50%. So if a person made the judgment, I think this is going to be one of those shallower 2015 era type declines. Maybe what could cause it to do that, which is kind of what happened back then, maybe, well, I don't know. If the Fed were to lower interest rates and interest rates actually came down and that spurred the economy, maybe there are tax cuts, maybe they're just kind of different stimulative measures, maybe the tariffs get all worked out. Those are all things that I think could certainly happen in the next year. If those all came together at the right time and everything worked out, then there's a good chance that this could be like the spot to be buying here. Down 50%, you could potentially get a 100% gain in a relatively, hopefully short period of time. I usually want it to happen within 5 years. If you go back to 2016, let's see what you could have done. There's more than 100. But you could have recovered, let's see, that was almost $100 a share. So if you bought it at 50, let's say on the way down, which would be what you would do right now. And let's just go 54, and then we go up to like 108. It makes a new high, or 110, something like that. So that would be kind of what you'd be looking to do if you thought this is going to be shallower, and you would have been able to do that in 2 years. So very good returns. I'm leaning the other way, I guess, partially just because I think, I'm not in a big hurry I've been buying a lot of deep cyclical stocks actually. So I bought a bunch of semiconductors back in April. Those are deep cyclicals. Some of those are almost back to their old highs again. And I have some other industrial ones I've been buying. So it's not like I'm short on these type of stocks. And I still think that there's a high risk things could not all come together perfectly in the next couple of years, and that we could have a recession or something close to it, especially with goods. So I'm leaning more toward buying at the 70% level. But if a person was more optimistic, maybe had more cash, maybe had just regular money coming in that they wanted to invest, this might be something like I could pick up for a weekly pick when I have to find something in the market each week. If I run out of other stuff, then something like this isn't too bad, even if you draw down more. So the positive part of it, maybe this is a good example. So let's see, that topped at 120. So let's say you bought at right here. Yeah. So let's say you buy that drawdown after about 50%. Well, you're going to fall more than that. You're going to have to sit through probably about a 40 or 50% drawdown in March. But if you hold through it, we want to get back up to 120 again, right about there. Okay. Now you get your 100% gain that you're aiming for. You get it in about a little over 2 years, which is totally fine, right? 1, 2. Can't quite tell where I started that. 2.5. You can maybe even call it 3, something like that. But that's still a very good return. It's a 30% CAGR. But you have to have the guts to hang on when it gets scary. So when you're down 50%, you have to understand if you're buying at these levels, it could fall 50%. I mean, there's a good chance that it could fall 50%. But if you hold through it, and sometimes if there's a recession, it takes longer for a recovery. I think they might have came back pretty quickly back here, but let's look. Let's say, what did we peak out at? Let's run the same thing. So we peak out around $18 a share. So let's say you buy it at 9 on the way down. Something right in there. Okay, so you want to hold it until you get a double. What did I say? Like 9. So we want close to $20 a share. So right about there. So how many years is that? 1, 2, 3. So that's 3 years. That's kind of what you would be looking at. But again, you would have had to hold through another 40% drawdown still. and do it when things are very scary and it looks like the world's falling apart financially. So that would be the warning, I guess, if a person was going to buy a little bit here. But I'm watching this one now. I'll be waiting. If I do buy it at down like 70%, I'll make a video for everybody since somebody asked for it here, and I'll let everybody know. So if you found this useful, hit the like and subscribe button. Make sure to check out the free tier over on Patreon, and I'll see everybody later.